What is going on, everybody? Today, we are going to look at a stock. Not just any stock, a stock that I'm invested in with 1,500 euros, which is about $2,000. Keep in mind, my entire portfolio is only 5,000 euros, which means that I'm relying on this stock for 30% of my stock portfolio, and a stock that I'm already up 17.8%, and I'm already up 265 euros. That's a stock, keep in mind, I bought 5 days ago. And that stock that we're going to be talking about is Sentinel One. Don't know if you've ever heard about the company, but just today, they're already up 5%. Hand over the yes sirs.
Yes, sir.
Anyway,
Yes,
let's
sir.
go
Yes,
into
sir.
it.
Yes,
So, Sentinel One,
sir.
they IPO'd in about June 2019 and then had a huge spike. But obviously, at that point, when they were $120 per price, they were completely overvalued. So, what happened? They had a huge slump. But the question is now, are they undervalued? Because their revenue surely hasn't stopped growing. Let's get into it. First, let's try and understand what is Sentinel One. Sentinel One is in the fight against ever evolving cyber threats. They basically act faster and smarter than human driven technologies. Why? Because they have an AI enabled cybersecurity that scales and scales across enterprise. So it's basically designed to evolve into the future and to help companies work. Now, if we look at a couple of IRE statistics from the government, we can see that the cybersecurity sector and sort of that entire area is supposed to grow immensely in the next 5 years. So let's go a little bit more in depth on what is Sentinel One. So Sentinel One is redefining cybersecurity by pushing the boundaries of autonomous technology. So our Singularity XDR data lake platforms delivers AI-driven threat prevention, detection, response, and hunting across all enterprise assets, from endpoints to IoT devices, containers, and cloud workloads. So basically, all of that fancy wording to say and they work with companies to protect them against cyber threats. And that they do that mainly by their one product called Pinnacle One. Right. So Pinnacle One basically offers a comprehensive suite of services that address the security challenges that today's organization is facing. They make money on both sides. They make money with corporate. They have deals with Ford. They have deals with Apple. It's such a big cybersecurity company that they have huge contracts with the biggest stocks in the market, while also serving the government. Next of all, one really interesting thing is that Sentinel One completed the acquisition of PingSafe. Right. So basically, PingSafe is just another sort of AI-driven cybersecurity company, but that focuses on another sector. And basically, what they're saying is that with the acquisition of PingSafe, Sentinel One is redefining what cloud security means by combining its AI-powered workload protection and Singularity Data Lake with a comprehensive CNAPP, which is basically PingSafe, to create, and then that's the point, a unified security platform that protects the entire enterprise. What is happening here? Anyway, all of that to say is that they're in a really, 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 really promising market and a really promising sector. AI company. That's all I'm going to say. They're a trusted AWS security partner, which was just a cherry on top, meaning that they basically help AWS run their business and to make sure that they don't get any cybersecurity attacks in their files. Now, one of their biggest competitor, right, is CrowdStrike. CrowdStrike, and why am I talking about CrowdStrike? I'm talking about CrowdStrike because their shares tumbled 20% in the last week. Why? Because of a global tech outage. Every single company that has Microsoft computers right now is on walking on hot flames. CrowdStrike had a huge breach in their data, and all of that led to basically them having a huge tech outage. So does that mean that a lot of companies are now switching from CrowdStrike to Sentinel-1, well, that's at least one of my hopes. So Sentinel-1, here we're going to look at a little bit of their above their comparison, right? So protection. Sentinel-1 has a high quality prevention, detection, and response features powered by patented behavior AI. It's patented, so only they have it. While CrowdStrike is human-driven, cloud-dependent, which is one of the reasons why the tech outage was so big, and it creates delays and missed detections. Another thing is detection. Sentinel-1 offers the most comprehensive and easy-to-view coverage of the MITRE framework, while CrowdStrike requires very delicate fine-tuning. Operation system feature parity offers rich features parity across all supported operating systems, including Windows, macOS, and Linux. While CrowdStrike does not provide any feature parity. They only work with rendered device. Anyway, all of that to say that Sentinel-1 is in a couple of sectors already better than CrowdStrike. And apparently their AI, which I've read a document a couple of days ago, is that their AI is actually more advanced than CrowdStrike's. Does that mean that they're going to steal a lot of customers from CrowdStrike? Well, potentially. Well, now let's look at their earnings. If we look at this graph, right, everybody would be amazed at that. But we don't know really what that means. So right here it says that is here, so that is 45%. 40%. So that right here is 40%. So they grew quarter on quarter 40%. That's a trailing 12-month revenue. That means they're still growing 40%. Before they were growing like 120, but they're still growing about 40%, which is really, really, really good. Let's go on their net income. They're basically net income positive, right? They're basically net income positive. If you look at this here, that's 0.32 billion, so 322 million that they're losing. So they're not even losing 100 million right now in their year. Next year, they're actually predicted to go net income positive, which is very exciting. But the question is, how profitable can they be? So they have gross margin of 72%, which is very good, but their net income negative 44% net profit margin. Now, why is that? It is because they are invested high into AI. They're investing and expanding their product every single second of every single day. I'm saying that, right, because if you look at Palo Alto, right, they have net profit margin of 14%. So that means is that Sentinel-1 can, without any problem, if they would not expand, not have such high costs in investing, they could simply in click of a button make 14%. So if we look at the full 2025 guidance, they're at 810 million, about 810 million. In Q 2024, right? In the 2024 full year, they made 621 million. And here they're making 810 million. What does that mean? Let's try and calculate the growth. The growth is extraordinarily sitting at 52%. So they're growing in their revenue growth. They're not growing 40% anymore. They are growing now 52%. Amazing. But the question is, with all of those high retention rates, low churn rates, high net dollar retention rates, good revenue, good AI, potential stealing customers from CrowdStrike, the question is it built into their valuation today? Well, what I did, I actually went onto my iPad and drew this out, right? So in 2024, they made 621 million. They forecasted in 2025, they will be at 810 million, right? So what I did is I projected this entire thing 4 years. So that's what I did. So 54%, we're going to arrive at 810. Then I said 45%, 1.1 billion, another 40%, 1.6 billion, and 35%. I made sure that the revenue growth was going down to sort of factor in any sort of low revenue growth or relatively low revenue growth that they might achieve in the future. 2.2 billion in revenue in 2028. That's the number. Let's calculate the net income. We would probably could multiply that by 15%, because if they would stop investing, right, they would make 15% profit margin, which comes out to be 337 billion in net income. Their current market cap 7 billion, which means that they have a forward PE in in 4 years of 20%, with the market back discounted back to today, while we projected it 4 years, which means that in 4 years, without any sort of stock movement, we would be at 20 P ratio. But that's not going to happen. Why? Because they should be at least at 60. At least at 60, which means they have a 3x. They have a 3x potential over the next 4 years. That right here, guys, is why I'm invested so heavily in this stock. And I think that every single second you wait right here and don't buy this stock is a missed opportunity. That's not financial advice. Obviously, do your own research, but that's just a stock that I'm keeping in mind.